If somebody asked me, what is that one skill I would not be able to trade without? And it would not be an indicator. It would not be anything really that you could add to your chart. It's something a little more subtle than that. And in this video, I'm going to talk about it. Of course, I'm talking about relative strength and relative weakness. And so in the next few minutes, I'm going to try to show you some examples of what that is, how to spot it, how to trade it, and how it can make you a super profitable trader in whichever directional market there is out there. And so, obviously first we're going to have to answer the question, like, what is relative strength, right? I'm not talking about RSI. RSI is something else. RSI shows you when something is oversold or overbought. What I'm talking about is the idea of comparing one instrument with another and assessing if one is stronger versus another, right? And so that's what we call relative strength. Relative strength is a way for you to keep track of what is being accumulated. And then when there is a directional move, you'll be able to get in, or perhaps you can get in before the move and take advantage of it, okay? So you can compare different things. You can compare a stock to an index, an ETF, and it doesn't really matter, really. You can compare a sector versus another sector, right? So we'll get into a few examples, but it's a really good way to assess it, not only on the daily time frame, which is what we're going to talk about here. It's something that you can leverage as a day trader as well, right? So let me give you a few examples. What you see here is a comparison between SPX and SMH, right? S&P 500 to the left, and then you have the SMH, which is the Van Wyck Semiconductor ETF to the right. And so what it shows us is that these two moved fairly equally as SPX was pulling down into this November 2021. That candle over here that you see is that first day of a bounce after this big move lower. And I've encapsulated the same day on SMH, which is this candle over here. And you can see that they're reacting fairly similarly, right? And, they're moving basically in step. When SPX moved lower, SMH moved lower as well. There weren't very big differences between these two charts, right? So here, there's no real edge when it comes to relative strength. They're equal, right? So there's nothing here that you could decipher to give you an edge, on which stock to trade or which sector to trade. Now, with all that said, let's take a look at XLV, right? This is the healthcare sector. If you can just zoom in here, you can see that this chart looks very, very different, right? You can see that we're starting down here with an upside move into this November 21st, which was this next leg higher. As SPX was pushing lower, XLV was gaining strength, right? And so what does that tell us? It tells us that they're accumulating, or their sector rotation into healthcare. Now, after a period of consolidation over here, as SPX was pushing lower, as a trader, what you can do is this. XLV is being accumulated, it's showing relative strength, as SPX is pushing lower. And this is a very simple way of putting it. There's a little bit more nuance to it. If SPX bounces, there's a high chance that the healthcare sector and the stocks within could break out of this bull flag or a bullish pennant and could provide us with that next leg higher. And that's exactly what happened, right? And so XLV, just to recap, XLV was relatively strong, moving higher, being bought up as SPX was moving lower. As SPX was bottoming over here, November 2021, XLV was flagging. It was flagging for about a week or so. When SPX bounced, XLV broke out. And so let's take a look at Eli Lilly. And you can see that November 21st was this candle over here. So as Eli Lilly was moving higher, SPX was moving lower. There's a few days of consolidation. It's not as clear as the XLV chart that we were looking at. And then when SPX bounced, look what happened. Eli Lilly pushed into new all-time highs. And, in this period here, I think everybody was talking about Eli Lilly and the amazing move with the break of 1,000 and a move all the way up to 1,100. And obviously now we're starting to retreat here, but that's not the point. The point is that through relative strength, the way I would have looked at this is, okay, instead of trading SPX, which is a little more speculative, I'm going to play the SPX bounce, or I'm going to trade the XLV bounce with Eli Lilly out of this consolidation area into new highs. And that's pretty much it. And so the same kind of format or the same kind of methodology could be applied to intraday trading. I'm going to not talk about it in terms of visuals here. I'm not going to show you visuals, but we're going to talk about it. And what I could say is this. If SPX is pushing lower and you see some relative strength in QQQ, right? SPX is moving lower, QQQ is holding in a range. What that tells us is simply that there's some accumulation, there's some relative strength in QQQ, and that is where we should have our focus if we want to play an intraday bounce. And what you can also do is you can pull up a chart of NVIDIA, of Microsoft, of Google, and some of the other stocks within the QQQ, Amazon. And instead of trading QQQ proper, you could trade one of those individual names. So you're comparing QQQ to SPX. That filters down your focus to tech. And then within tech, you can compare the individual names against each other or to QQQ, and you can assess where relative strength is or not. On this day, let's say that Amazon is relatively strong, which it actually is right now. So what we're going to do here, we're going to add QQQ to the chart, and QQQ is looking like this on the 10-minute. And I said we're not going to do this, but I'm going to do it. I changed my mind. You can see that there was a little bit of relative strength on this bounce, right, in QQQ versus Amazon, actually. So in this instance, it would have been a better idea to play QQQ proper. But had we seen QQQ, Amazon bounce, back to the highs, that would have been an excellent vehicle to play that bounce in terms of relative strength to QQQ. Okay, so just to recap, you can compare ETFs to each other, index to ETF, stocks to ETFs or indices. And then within that basket, you could kind of further narrow down your focus to take a trade. I've talked about relative strength, but it works the same way, relative weakness. If you do see a bounce in QQQ, but a stock like, for example, Netflix, and I haven't looked at Netflix today, and that's a pretty good example, actually. If you see that QQQ is moving lower and then bounces, but at the same time, Netflix is making new lows, that is obviously relative strength. So weakness. Netflix is relatively weak to QQQ, or QQQ is relatively strong to Netflix. It's better to look at the stock and compare to the larger entity, which QQQ is in this instance, right? So in terms of if you believe that we might pull lower today, perhaps your focus should be on playing at Netflix puts. The one kind of caveat or a little warning that I would say here is this. Sometimes relative strength gets worn out intraday. So what I mean with that is simply there might be relative strength for a certain amount of period. And then when the SPX bounce comes or when QQQ starts bouncing, let's say you're playing the Amazon bounce to the upside as the vehicle to play long. If it has been consolidating and traded higher as QQQ have been chomping around, sometimes that relative strength gets worn out. It's not infinite, right? It's a finite state that could change. And it could change when you anticipate that move to the upside. It could just go to the opposite side. And so it's just like a side warning, I would say. It often plays out in the direction that you're anticipating. Sometimes that relative strength weakens and it actually displays relative weakness. And so there's a little bit of an art to it. But what I would say is simply being able to assess relative strength versus relative weakness from one area of the market to another allows you to be flexible, allows you to be able to trade in any market, as well as that you'll be able to assess rotation, which is a bit more advanced, but the XLV example was a really good example of rotation, where you have money coming out of big tech into healthcare, or big tech or semiconductors into energy or miners, or any other little bit more defensively skewed part of the market. So if this was helpful, feel free to hit the like. I really appreciate that. If you can repost this, it would help others to see this kind of content. And I appreciate you guys very much for spending a little time with me today. And until the next one, take care. Bye.